Hello and welcome back everyone to Almus Market Mornings, your daily dose of global financial updates. I'm your host Swaraj. We are back for giving you some market updates in this rather slow holiday period. Globally, some of the major countries go on a holiday period right around Christmas and join back post New Year. Meanwhile, much of the asset classes remain range bound during the slumber period. Good morning, Pankaj. Any interesting developments you have been tracking during this period? Indian rupee seems to be in a different world altogether by trading very close to 83. What are your thoughts?
Good morning, everyone. Probably this is going to be a last update for 2022. And before we look at what might be stored in 2023, let me summarize briefly the market and economic events of the week. There were hardly any data from Europe or UK, but most of the news came from US, but not very significant enough. US posted much lesser deficit on goods trade than the expected. Important things to note that there's a good amount of jump happening in the services where the drop in a purchasing goods. So basically, economy shifting from a consumption of goods to consumption of services. US housing market slump has been really looking more realistic by more data showing that the house prices and sales both are coming down. Today, we are expecting a weekly jobless claim. It is likely to show claims increasing after showing a drop over the last few weeks. There would be a seasonal factor also in this play. As for the markets, what we are seeing that the yields have started moving higher, whether it's a Germany or whether it's a US. Germany 10-year has already reached almost to the 2.53, which is high seen in October. Since inflation in Eurozone remains very, very sticky, and I'm seeing that the fiscal challenges being faced by Italy. So these are the two major reasons for Eurozone higher in yields. And US also 10-year yield has jumped by 44 basis in last 2 weeks, and 2-year yields jumped by 20 basis. So what I can see that the post CPI inflation data, whatever the yields have moved to lower, they are coming back. Now the yield curve has remained basically a negative inversion by only 48 basis, which was around 85 basis 2 weeks back. We have seen a very narrow range move in dollar index, and week on week is hardly 10 basis as of now. But what we are seeing, euro is finding a good support at 1.0660, and buying levels emerges around 1.0580. GBP is not able to cross 121, while USD JPY has got a good amount of a support at 132. Now, these higher US yields and overbought condition in these currencies might see some kind of a reversal back. On a YOY basis, dollar index has seen a very good move. 9% up move we have seen, euro losing 6.5%. These numbers YOY looks very senile in basically seeing only 6.5%. But if you look at the cumulative move in euro during this week, during this year, it was almost closer to, I would say 28 to 29%. GBP 11% and JPY is staggering 16.5%. Chinese yuan also lost almost 10% during this calendar year. Coming to our currency, is basically in rupee weekly range had been a very, very flat 30 paisa during this week. But what we are seeing is a kind of a good buying demand happens for dollar, and supplies are not there. Some point of time, we also observe that the state-run banks are both on the both side, buying and selling within the 20 paisa range. We are not seeing much of exporters hedging also since the quarter ending is around. Let's see how it moves in next 2 days. Forward premiums have moved lower by almost 10 paisa, which is also a function probably is the US yields have started moving higher. We will have a current account number tomorrow for this for the September quarter. It's expected to be around $33 billion against the $24 billion last quarter, which is closer to 3.8 to 4% of a CAD number. Seems very high, and that's taking a toll on a rupee particularly. As we move forward in the next year, challenges looks more in a way that how the global economy will be taking shape, how the central banks will be taking action. But I think next year we should also be watching what the statements guys are doing, that what the prime ministers and presidents are going to do, whether it's a geopolitical risk or whether it's a politics or whether it's the elections. We'll be seeing many of the things happening in the next calendar year. From a central bank point of view, market would be observing whether Fed pivots. Uh, Europe still remains a worry because inflation sees on a higher side, and Japan, which is loner at this point of a time of inflation fight, they are coming back. So, what the next action on the inflation fight would be, we will be observing from a Japan side. We should noticing that the Japan is a currency which moved last year. If you look at the absolute number, it has depreciated by 35% and then recovered back. So Japan would be the one currency which will be we will be observing because their basically governor also moving out. Kuroda would be moving out somewhere in March, April, and the new governor would be coming, and his actions would be designing the next year financial market action. But I would like to end with a note of optimism. Sometime I think we should be realistic, but yes, we would like to end with a note of optimism. That year 2020 was very gloomy and bad for economy, and markets after COVID struck the world. But we have seen after the central bank actions, there was a strong bounce in the 2021. We have observed significant amount of upsets both stocks and bonds in 2022. Let's see how it unfolds in 2023. I believe that 2023 would be a year of a consolidation in major developed market. India will have a preparation for election in 2024, and we'll be watching how the fiscal deficit numbers would be looking in the upcoming budget. It seems that the markets have started pricing that 6% fiscal deficit is given in the Indian economy, and that will not sound good for both bonds and currency. All the best, and we will come back on mostly 3rd of Jan. If we would have a major developments over next 2 days, we might come back on 2nd Jan itself. 2nd Jan is a US holiday, global market holidays. So we will be back in the next year with a lots of market info, market updates. Thank you. Have a nice and happy New Year.
Thank you, Pankaj, for that crisp updates. And as Pankaj mentioned, we have been seeing some slump in the US housing market. And from the US, we have got the weekly jobless claims data, which is due today. We saw some jump in US and German yields, while yield curve in the US remains inverted, and the degree of inversion has come down. Of course, you very well covered the challenges for next year, which would be, geopolitical risk, election risk, and from a central bank point of view, whether the Fed would pivot. Well, that's it for today. As we end 2022, it would be probably a good time to introspect on the key learnings during this volatile year. We wish all of you a very happy and prosperous new year, and we'll see you on 3rd of January. Or if the updates are drastic, we'll also see you on 2nd of January with the latest round of fresh updates as markets wake up from their slumber. Thank you so much for listening.